Welcome back to the show. Today we're exploring something every investor experiences, but few ever talk about openly: regret. Why does the investment you didn't make often haunt you more than the one that lost money? Joining us is a behavioral finance expert who spent years studying the psychology behind our financial decisions. So let me ask you this: why is regret such a powerful force in investing?
That's a fascinating question because surprisingly, investing isn't primarily about numbers. It's about emotions. The market may move on data, but people move on feelings. And among those feelings, regret is one of the strongest. Think about it. Most people don't spend years replaying every stock that fell by 10%. They replay the one they almost bought that went up 1,000%. Someone says, "I almost bought Bitcoin in 2013, and suddenly they're mentally calculating the millions they could have had. The brain treats that missed opportunity almost like a real loss, even though the money was never yours in the first place. That's because our minds are wired to imagine alternate realities. Psychologists call it counterfactual thinking. We constantly ask ourselves, what if? What if I had invested? What if I had held on? What if I hadn't sold? Those imaginary scenarios often feel more vivid than reality itself. What's interesting is that regret doesn't just come after investing. It shapes future decisions. Someone loses money during a market crash, and instead of learning from the experience, they avoid investing for years. The pain becomes a permanent filter. Ironically, by trying to avoid another loss, they often miss the recovery that creates long-term wealth. Then there's FOMO, the fear of missing out. You watch your friends celebrate gains in AI stocks, real estate, or cryptocurrencies, and suddenly your brain whispers you're falling behind. That voice rarely encourages careful analysis. It pushes urgency. And urgency is one of the most expensive emotions an investor can have. History repeats this pattern. During every major bull market, people chase yesterday's winners. During every crash, they panic and sell. Then when prices recover, they regret selling. It's a cycle driven less by economics than by human psychology. One bias I find especially fascinating is hindsight bias. After an investment succeeds, everything seems obvious. We tell ourselves, I knew that company would become huge, but we didn't. If the future were obvious, everyone would be wealthy. The market rewards uncertainty, not certainty. The investors who build lasting wealth aren't those who never experience regret. They're the ones who refuse to let regret become their financial advisor. They understand that every decision is made with incomplete information. The goal isn't perfection, it's consistency. Warren Buffett has missed countless opportunities, yet he doesn't lose sleep over them because he follows a disciplined process instead of chasing every headline. That's a lesson all of us can borrow. Here's a thought I hope stays with you. Your biggest financial enemy probably isn't inflation, taxes, or even market volatility. It's the emotional story you keep telling yourself about what could have been. Every minute spent mourning a missed opportunity is a minute you're not preparing for the next one. Wealth isn't built by predicting every winner. It's built by making thoughtful decisions, staying patient, and accepting that no investor catches every opportunity. Regret is inevitable. Letting it control your future is optional.
I love that perspective. Regret will always be part of investing, but it doesn't have to become part of your identity. If today's conversation made you rethink the way you approach money, share it with someone who needs to hear it. Until next time, invest wisely, and perhaps even more importantly, think wisely.